makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Zurich with what's coming up in today's program. UBS soars after outperforming expectations in the first quarter as wealth and investment banking beat.
Actually, it's a good momentum. You may remember in the fourth quarter, we also had a very strong performance in banking. As we integrate the new colleagues from Credit Suisse on our platform, we start to see the pipeline developing. We are able to execute.
More from our interview with the Chief Executive, Sergio Ermotti, coming up shortly. Now, the world's biggest oil exporter, Aramco, keeps its $31 billion dividend payout despite lower profit. BP maintains the pace of share buybacks despite missing estimates. And Israel rejects a ceasefire proposal backed by Hamas hours after the militant group agreed to the plan, while Israel vowing to push ahead with military operations in Rafah. Well, let's take a look at the European markets map. Again, it's Tuesday and there is a lot going on. We do have a couple of Fed speakers a little bit later on, but if you look at European stocks in general, actually advancing on a pretty busy day for company earnings. Optimism also growing that the Fed will start cutting interest rates this year. Now, UBS, I think, gaining more than 6% after a return to profit. UniCredit also up on better than expected forecast. If you look at the 10-year treasuries extending some of their advances, the yield actually dipping 2 basis points to 4.46%. So let's look at cross assets. We are looking in particular to a lot of these treasuries because of auctions coming up. And then we have the Minneapolis Fed President Neil Kashkari also amongst some of the officials scheduled to speak a little bit later on Tuesday. I'm looking at oil actually advancing for a second day again on tensions in the Middle East, with Israel rejecting that ceasefire proposal for the Gaza Strip. And then you can also see yen 154.12. So the Japanese yen actually slipping. We did hear from the top currency official in Japan, Masato Kanda, saying there was no need for the government to intervene if the market is functioning properly. I'm really looking forward to our conversation with George Saravelos on all things currencies. Now, back to corporates, and UBS shares gaining their most since March of last year after the Swiss lender beat earnings estimates and returned to profit after 2 loss-making quarters. Now, strong performances in both wealth management and investment banking are helping UBS to really make sustained progress with the integration of Credit Suisse after its emergency rescue last year. Well, the Chief Executive, Sergio Ermotti, spoke to us about the company's performance, inflationary outlook, and of course the impact of capital requirements.
Depending on the outlook for rates and the economy, I would say if inflation comes down to the 2% targets and central banks are able really to cut rates, this may give a little bit of positive momentum. But on the other end, we need to also expect some uncertainties around major elections globally and how they play out in more so in economic terms, in terms of trade wars or potential escalations of that matter, and even on the geopolitical front.
Sergio, do you worry that proposals put in place by Swiss authorities on capital raising really for systemic banks overshadows some of the work that you're doing at UBS?
Look, I think that we agree on the vast majority of what has been proposed. We already commented and highlighted the necessity of creating clarity. I think that at this stage, what we stay focused on is on executing on our strategy. We were not really consulted in this process, so it's also very difficult for us to comment certain aspects of those proposals. What we know is that we need indeed to absorb a lot of the capital requirements that are necessary to capitalize the new bank as a consequence of the acquisition of Credit Suisse.
But we've heard figures from 15 to 25 billion. Do you have a ballpark, or actually is there a very wide range of scenarios?
Well, there are 2 elements which we know. If I look at by absorbing and Credit Suisse, we have to basically bring their methodology for calculation of capital to our standards. And that means that we're going to have to basically increase the requirements by 9 billion. If I look at also the progressive element of that is driven by market share and balance sheet size, we are also expecting another 10 billion. So we are talking at around 20 billions of additional capital that we already factor in our financial planning and targets for 2026. So we know that, indeed, acquiring Credit Suisse will cost UBS around 20 billions more capital. So that's the only comment I can make. Other figures, I can't really comment on them because I don't know exactly what they mean. And it would be not appropriate for me to speculate or respond to speculations.
But so is your working assumption that actually, even in worst case scenario, it won't actually hurt the dividend? It's not going to hurt some of your financial targets?
Well, that remains to be seen because as these rules are developed and clarified, we will need to then assess exactly how they play into our capital return plans. For 2024, we are accruing for a double-digit increase of our cash dividend, as we previously communicated. So in the first quarter, we did that. And after the parent bank merger at the end of May, we will be prepared, if everything goes as smooth as we expect, to execute on our 1 billion capital return plans, i.e. through share buybacks.
So when do you think you'll get clarity from Swiss authorities? I mean, a timeline, I guess.
I think this is still, so for me it's very important, and I do expect that no final decision will be taken before the investigating commissions of the parliaments clarifies all what happened around the failures of Credit Suisse. I think it's very important not to jump into conclusions too quickly about this matter. So if you look at that matter, it's very difficult to expect clarity before year-end or probably even the first part of 2025.
Well, we'll bring you more from that interview with Sergio Ermotti, the UBS chief executive, a little bit later on in the show. Now, markets have been buoyed by optimism that the Fed will start cutting rates this year. Investors are revising their bets due to soft U.S. jobs data. Well, I'm delighted to be joined by Simon Dangoor, head of fixed income macro strategies at Goldman Sachs Asset Management. Simon, great to see you. I can't believe you're in London and I'm in Zurich, but it goes that way when you have big earnings out of Zurich. When you look at the global macro environment, Simon, is there a misunderstanding from parts of the markets of what the Fed does?
Thanks very much for having me this morning, Francine. Q1 inflation in the US was clearly disappointing, but when we look at the broad drivers of inflation, we're in a totally different place to where we were in 2022 and 2023. Inflation expectations are well behaved. The labour market continues to show signs of easing. We got more information favourable to that on Friday. And so we believe that we're going to see more disinflation play through over the course of this year, and therefore Powell's wait-and-see strategy is the right one, and that the risks of new hikes from the Fed remain quite low, and we are likely to see cuts in September. So we think the Fed is guiding to something which does look like an appropriate strategy. We think investors have broadly got it. In many respects, the most interesting tactical opportunities in fixed income markets right now maybe are in this time zone. And we'll get some more information from the Bank of England and the Riksbank this week, which will be interesting to follow. But the broad picture is that the bond-friendly environment has been delayed rather than derailed, and we've got a friendly central bank behind that.
So, Simon, we're expecting, of course, a lot of European central banks. I'm thinking of the Bank of England and the ECB of actually cutting rates far quicker than the Fed. Does the gravitational pull towards the Fed actually complicate things for European economies?
I think ultimately the Fed does matter. The Fed sets the price of global capital to a large extent. But I think it's important to remember the starting point of rates out in Europe and the fact that we are very clearly at levels that are above neutral. I think you can see a picture that things are much clearly tight in Europe, and particularly if you look at a place like Sweden, probably a place where you can make the strongest case that things are tight. And so certainly the first 100 or so basis points of cuts, we think, can be done quite independently of the Fed, and that leaves us constructive on parts of fixed income out in Europe.
So what does that mean for example, places that you like in Europe with that first cut in June coming from the ECB? What happens next? And does it impact, to a point, a lot of the Italian bonds or German bonds to where you want to come in and swoop some of them up?
Well, I think that in many respects, Europe seems better priced than some of the other markets. So the ECB, we expect they're going to cut in June. That's well priced by the market here. Something like 3 or 4 cuts over the balance of the year would be where our expectations are. So upside in European fixed income, we like steepeners. Ultimately, that will be a positive backdrop for European credit, including sovereign bonds. I think where the real opportunities are some of the satellite markets in Europe, UK. The market's priced for only 2 cuts from the Bank of England this year. We expect the Bank of England will probably start cutting in June. The debate in the market has really been about whether inflation risks in the UK are different or similar to elsewhere. All of our analysis suggests that they're more similar. We're seeing signs of things easing up in the labour market. We're starting to see members of the Bank of England that had previously been more hawkish start to talk in a more open-minded case towards a dovish outlook. I think Hugh Pill is going to be a key person to watch if he makes the transition over sort of coming communications. So expecting the Bank of England to start to lean more dovish when we get communication from them on Thursday, cut in June, and cut much more than what's priced into the forecast. So that, in this time zone, is where we sort of lean more constructive. European fixed income itself looks somewhat better priced.
Yep. Simon, what about the Bank of Japan and actually what that means for Japanese assets? I don't know whether, again, the schism or actually when we really start this divergence play, what that means for opportunities in the markets.
Well, this is one of the fascinating things about 2024. In many respects, the opportunities are not necessarily just in the overall level of rates, but in how different parts of the G10 are going to be heading in different directions, which is obviously quite a different setup from what we've seen over the course of 2022 and 2023. We've talked a little bit about sort of Europe decoupling somewhat from the US, but the big decoupling we think is in Japan. The inflation process in Japan is in a different place to what we've been used to in Japan for such a long period of time. You see that in wages. You see that very obviously in inflation expectations. And whilst there's not runaway inflation by any means in Japan, the starting point of real policy rates in Japan is just so far away from what we see in the rest of the world. That real yield gap is really as large as it's ever been. And with that, we're seeing this sort of very significant depreciation of the yen. We might get periodic interventions like we saw last week. But ultimately, until that real yield gap closes, there's going to be upward pressure on the Japanese inflation process. So we're surprised that the market, particularly in the intermediate part of the curve, doesn't put more risk premium around the idea that the Bank of Japan is going to have to go faster than what's currently priced. And this is going to be an interesting world. Bank of Japan hiking rates, US potentially cutting rates later this year, and Europe going in the middle of the year. So divergence, and with that, quite a lot of active opportunities, we think is going to be the story from here.
Yeah, and so Simon, when does that change? When does the market realize what you were talking about? Is there like an opportune window to get in there?
Well, for Japan, we think that ultimately one of the things that has been holding things back is just the lack of supply of Japanese bonds for the markets to buy. The Bank of Japan is likely to start to pull back on their rinban purchases. That's going to create some more duration supply to the market, and we think that can start to allow more risk premium to build up in Japan. But we think that the risk reward right now is very attractive, both outright to be underweight Japanese bonds, but also to be underweight Japanese bonds versus some of the markets in Europe, which we could see fall to lower yields.
Sam, very quickly, any worries about some of the auctions in the US?
I mean, obviously, this has been a fascinating subject, and the market has sort of struggled over the last 6 months or so to really calibrate how to price the fact that we've got an enormous amount of duration to buy when you look out over the medium term. And it's one of the reasons that in our duration positions, we tend to favour steepeners. But I wouldn't overstate the risk that comes from the bond supply. I think that the Treasury have made a lot of progress in giving the market a lot of transparency and visibility about what we're going to get in terms of duration supply. I think what investors sometimes under-focus on as well is that private sector duration supply is likely to be quite low. This is one of the reasons that leaves us constructive credit markets, and we think that we can stay in a sort of tighter for longer environment because the incentives to issue debt are much, much lower than has been the case over the last 10 years or so. And that's ultimately going to be something of an offset to the very heavy duration supply out of the Treasury. But for sure, we're probably going to be living in a materially higher term premium environment than we've been used to for some time.
Simon, thank you so much. Simon Dangoor there from Goldman Sachs Asset Management. Much more to come, and this is Bloomberg. Now, energy giant BP is maintaining the pace of share buybacks, even as first quarter profit fell by more than expected amid lower natural gas prices. Meanwhile, the world's biggest oil exporter, Aramco, is to pay $31 billion in dividends to the Saudi government and other investors. Let's get more from Bloomberg's Middle East energy editor, Anthony Di Paola, who's in Dubai. Anthony, thank you for joining us. So dividends, of course, one of the biggest focuses for the big oil companies this quarter. What's BP doing?
Yeah, good morning, Francine. Yeah, that's true. Getting cash back to shareholders was a big theme across the majors and the big oil complex for this quarter. So BP largely missing on a lot of those estimates, but kind of heartening investors with that pledge to give back $3.5 billion in the first half. And they've also made some promises of some cost cuts as well, too. So trying to improve some of those metrics by taking some costs out, and then looking at that all-important stock price issue for them with this buyback issue. So that's really following a theme, even as the oil companies are suffering largely lower profit because of some of the slump in oil prices, of course, from those highs of 2022 when we saw all those companies posting bumper profits.
So, Anthony, how's Aramco's dividend policy developing, and why is that so important?
Yeah, well, Aramco's got a pretty clear dividend policy set out for this year. They've got a base dividend which they want to keep growing and increasing. They want to have that being progressive, and then they've got this special dividend which is based on again that 2022 bumper year and 2023. So that should be largely set out for this year. They've had a roughly 20% increase, so about $120 billion in dividends, which is going to be the plan for this year. But that's so important because that's necessary really to go into those Saudi government coffers. Saudi's got a lot of spending coming up. They're having to tweak some of the project plans and cut back on some of the issues. So they really need that income from Aramco coming in. And so that's why it's very important. But we're also watching cash flow, and we're watching investment from Aramco because, of course, those things can be impacted by that dividend that's going over to the government, Francine.
Anthony, thank you so much. As always, Bloomberg's Middle East energy editor, Anthony Di Paola. Now, coming up, Israeli troops seize the Rafah border crossing in Gaza as hopes for a ceasefire deal dim. We'll have the latest on the Middle East conflict next. This is Bloomberg. Israeli troops have taken control of the Rafah border crossing in Gaza this morning, with Hamas saying all aid flowing through there from Egypt has now stopped. Now, this comes after Israel's war cabinet rejected a ceasefire plan backed by the militant group. Well, I'm joined by Rosalind Matheson, Bloomberg's EMEA news director, who's been, of course, keeping on top of all these developments. So, Ros, how much is this a precursor to a proper ground offensive in Rafah?
Well, certainly it's an important signalling exercise, the fact Israeli troops have moved into the Rafah border area, the crossing area, for the first time since the conflict broke out. And as Hamas and Arab media are saying, that's cutting off the flow of aid and people in of that crossing between Egypt and Gaza. And really following the airstrikes also that we saw on parts of Rafah last night, it is that signalling moment, which is despite the fact that Israel has said, we will still go on with talks on a ceasefire, we won't agree to the current terms, we're willing to keep talking. At the same time, they're making their preparations for an offensive inside Gaza. They're moving to get a lot of people out of the way. They have to relocate an awful lot of civilians out of harm's way. And it's really saying, no matter what happens with those talks for a truce, our intent is still to go into Rafah because our overall goal is to try and eradicate Hamas.
So what do we know about the current status of the ceasefire talks?
Well, Israel says it's willing to sit down and keep talking, although it rejects the current agreement, the one that that Hamas said it would sign up to. And there's a lot of disagreement over small amounts of wording in those talks. But it's really about what the language would be in that agreement for a ceasefire that would be the prelude to a proper end to the war. How does this ceasefire pave the way for that war to end? That's what Hamas wants. Israel says it wants to be more open-ended because, obviously, again, it wants to have the option to keep fighting against Hamas inside Gaza. So we're going to see the talks continue, but there's not a lot of prospects for an agreement. And time is obviously running out to use that ceasefire to stop an offensive inside Rafah.
Roz, thank you so much. Rosalind Matheson there, Bloomberg's EMEA news director. Now, coming up, comments by the U.S. Treasury Secretary are piling also more pressure on currencies such as the yen. We discuss a strong dollar and, of course, what it all means for FX. This is Bloomberg. Well, UBS soars after outperforming expectations in the first quarter as wealth and investment banking beat.
Actually, it's a good momentum. You may remember in the fourth quarter, we also had a very strong performance in banking. As we integrate the new colleagues from Credit Suisse on our platform, we start to see the pipeline developing. We are able to execute.
Aramco, the world's biggest oil exporter, keeps its $31 billion dividend payout despite lower profit, while BP maintains the pace of share buybacks despite missing estimates. And Israel rejects a ceasefire proposal backed by Hamas hours after the militant group agreed to the plan, while Israel vowing to push ahead with military operations in Rafah. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Zurich. Now, Chinese President Xi Jinping has called on France to help fend off what he called a new Cold War. Xi is on his first visit to Europe in 5 years with the aim of resetting ties with the European Union. So let's get more from Bloomberg's Caroline Conan in Paris. Caroline, thank you for joining us. Has there been any progress made between the two leaders?
On the geopolitical front, we can't say there has been any progress, really, even though the President Xi called for a ceasefire in the Middle East. Shortly after, you had these airstrikes on Rafah in Gaza. But Macron did try to use China's support in order to weigh in the war in Ukraine. You know, the relationship with President Xi and the Russian President Vladimir Putin has been quite close. And in fact, Vladimir Putin will travel to China shortly after Xi returns from Europe. On the trade front, it was also quite frictional because you had the EU Commission President Ursula von der Leyen, who participated in the first trilateral meeting with President Xi, and she had very tough words criticizing China's production surplus, saying the world cannot absorb it all, and the EU was ready to use all the available tools to protect itself. President Xi rebuffed all these calls, saying that China does not have an overcapacity issue. And in fact, President Macron had a much more pragmatic approach, saying that the trade policy of the EU should remain independent, meaning independent from the US, so trying to distance himself from this position of von der Leyen. There wasn't any major business deals announced, only a few cooperation agreements in the aviation sector, for example, or the cosmetics sector. But President Macron did have a small victory when it comes to cognac, saying he was hopeful that China would abandon their measures against the French cognac makers. In fact, Macron gave President Xi as gifts 2 bottles of cognac, one from NSC and one from Rémy Cointreau. And today, as we speak, they are landing in the Pyrenees in the southwest of France for a little bit of an appeasement and a little bit of a fun side of the trip. Macron will take President Xi to the Pyrenees Mountains, perhaps to appease the frictions from yesterday.
Yeah, quite amazing, actually, extraordinary, Caroline, because I think he's taking him to where his grandmother lived and grew up. So I guess it's quite unusual. It's as a sign of friendship to bring him there. Caroline Conan there in Paris. So we'll follow, of course, President Xi's visit to the mountains. We also look at the Bank of Japan, the yen remaining under pressure, and some in the market think it could slide back to 160 per dollar. Now, that's in the wake of comments by the Treasury Secretary, Janet Yellen, who said the U.S. expects interventions to be rare and consultations to take place. Well, our next guest says FX intervention is not credible and that Japan is following a path of benign neglect for the yen. Well, let's discuss all of this with George Saravelos, Global Head of FX Research at Deutsche Bank. George, first of all, thank you so much for coming in. I've been waiting and pacing to actually have your take on yen and what happens next. There was an interesting, actually, line from the top currency official in Japan, Masata Kanda, saying there was no need for the government to intervene if the market is functioning properly. But we also understand that the BOJ governor is currently possibly meeting with the Prime Minister of Japan. What do you think they're telling each other?
Thank you, Francine. It's great to be back on your show. So it's interesting because you're starting to see some divergence between the rhetoric coming out of the BOJ and the actions of the Ministry of Finance. Governor Ueda actually gave an interview to the Peterson Institute just a few days ago where he talked about inflation not really being a major problem, as in they're still trying to get it to 2%. At the BOJ meeting itself, he was talking about the yen not being a huge driver of the economy, not being hugely relevant for inflation. And then we got MOF intervening. I think the Ministry of Finance intervened because price action did start becoming disorderly. You did see very large moves that were unusual as we went up and broke key levels. But at the end of the day, the fundamental driver of yen weakness is the fact that real rates in Japan are extremely negative. They're below minus 2%. And as long as that's the case, we think and as long as the Bank of Japan doesn't hike rates expeditiously, we think the yen will stay weak, unless you've got a view of a US recession, which we don't have.
George, we're just getting actually some breaking news from the BOJ governor saying that he discussed FX with the Prime Minister. He also says they're closely monitoring the recent FX situation. I mean, that was probably expected. I'm sure they are monitoring. So you're not expecting any meaningful intervention because of what you're saying on real rates. I mean, is there, if they wanted to intervene, would it actually not make a difference?
I think it's very likely we did see intervention. If you look at the Bank of Japan current account data, we'll see confirmation of that in a few weeks. But actually, the intervention we saw was very much in line with history. It was, we saw a 2-week move in dollar-yen of more than 4%. So the price moves were extreme. And I think the MOF, Ministry of Finance, is becoming quite open that they don't want very large disorderly moves. We have to remember that dollar-yen moved by 10% higher over the course of this year, more than 10%, and they didn't do anything. So they intervened when the move became disorderly, as they said they would, and I think that's fair enough. But in terms of managing to get the yen structurally stronger, it's all about the Bank of Japan. And as long as the Bank of Japan doesn't have urgency, you'll see these very negative real rates, which are prompting these continuous outflows from the Japanese. So at the start of the year, for example, you saw record outflows from Japanese investors into US equities, into foreign assets, and they're doing very well out of those investments. So you need the real rate to change out of Japan.
But, George, we sometimes forget, I just came back from a family trip to Japan, and actually it felt like everyone was there from all over the world to try and catch a glimpse of these cherry blossoms. I mean, yen weakness could have its advantages.
Absolutely, and in a piece we wrote a few days ago, we said if you look at the Japanese economy, as you mentioned, tourism is doing very well because it's very cheap. But I think at the core of the issue is when Japanese real rates are so low, it actually creates fiscal space for the government. It allows for asset price reflation. And if you look at the level of inflation in Japan, it's very different from 2 or 3 years ago in the US and Europe, where we were at levels at 6, 7, 8% inflation. In Japan, it's at 2%. So yes, the yen is contributing to some inflation, but the level of inflation discomfort is much lower. And that's why you have consumer confidence, which is actually at cycle highs, in contrast to the US and Europe. I'll mention one last thing on... sorry, go ahead.
No, go ahead, George.
One last thing on the tourism issue. You said you've been there, it was very cheap. I have a number of colleagues who've been there, and they observed the same thing. But if you look at the trade balance, yes, it's moving in a more positive direction. So Japanese exports are becoming cheaper, so the Japanese are able to export more. But it's not into a huge surplus. The trade balance is not at extremes. So that's telling you, while dollar-yen valuations, when you look at them on a chart, they look very extreme, it's not yet translating into massive export outperformance, into a huge current account surplus. So perhaps these valuations are not as extreme as history may imply.
George, what's your take on Janet Yellen and actually her appetite to lead intervention? She was at a press conference a couple of weeks back with the finance minister of Japan and Korea and seemed to suggest that, yes, dollar strength is a problem for a lot of people, but then she seemed to also be walking back on some of those comments in the last couple of days.
So I thought that was a fascinating comment because, as you alluded to, we did have a joint statement from Korea, the US and Japan about currency moves, and the market interpreted that as potentially the US Treasury validating intervention from the authorities. And it was a bit of a walkback in terms of expectations of intervention, being that it's rare when it happens. I think it's also interesting if you contrast it with some of the comments coming out potentially from President Trump in terms of the levels of dollar-yen being too high and stories around changing dollar policy. So there is a bit of a difference emerging between the current administration, where despite a strong dollar, which is creating pain in manufacturing, this insistence on maintaining the G7 commitments and also the separation between Treasury and Fed, that is coming up as a divide between potentially the approach of a potential second Trump administration. So as far as the dollar direction goes, we are very attentive to rhetoric on the dollar, especially potentially from Trump administration officials. And does that rhetoric eventually translate into a weak dollar policy? So we are dollar bulls, but we're watching this issue of weak dollar policy as a potential issue for the dollar over the next few months.
I know Fed expectations are moving all over the place, but what's the percentage chance of a rate hike at this point from the Fed?
I think it's still quite low because even though you have headline inflation, core inflation, which looks stuck around high levels, if you look at everything else the Fed is looking at, so for example, the labor market, all the key indicators of slack in the labor market, they are building. This owner's equivalent rent issue, which is keeping inflation again elevated, all the forward-looking indicators are coming down. So I think the bar, as communicated by Powell, is very high for a hike. This being said, if inflation does stay very sticky at these levels for the next few months, I don't think we can rule anything out. And as you mentioned, the market was pricing 50 basis point of rate cuts this last March, and we saw how uncertain and how things can change. I think the key issue when you look at the US economy and the key reason that's driving this structural outperformance versus the rest of the world is, number one, fiscal policy. You just have this continuously expansive fiscal policy, which you've never seen before, much larger than the rest of the world. Now, if that was to persist after the election, if fiscal policy was to be even more expansionary, that would be a major inflationary driver. And at the same time, you have an economy that's extremely deleveraged. So if you compare private sector leverage in the US versus the rest of the world, it's extremely low. And that's what's providing the robustness and I think the consistent US outperformance over the last year or so.
George, finally, we have the Bank of England on Thursday. Some of the hawks have turned less hawks or less hawkish. What are you expecting from the Bank of England, and what does that mean for sterling?
So our house view is that the Bank of England does start cutting in June. I would say the risks to that are definitely skewed towards later. When you compare inflation in the UK versus the rest of the world, it looks a lot more similar to the US in terms of it looks stickier. When you look at fiscal policy, again, the rest of the world, Europe in particular, is tightening policy. In the UK, it's staying easier. So I think that combination does justify to some extent the market not pricing that many Bank of England cuts. And in terms of the pound, as long as the market is in this soft landing scenario, which I think is a very reasonable scenario to have, the pound's a high yielder. The UK's avoided a recession despite 5% rates. And again, here the UK looks a bit more similar to the US because of low levels of private sector leverage since Brexit. So if I put all these together, I think even if you get a Bank of England rate cutting cycle, it will be gradual. Pound stays a high yielder, so we expect it to stay strong unless you get a recession.
George, brilliant as always. Thank you so much for coming on. George Saravelos there, Global Head of FX Research at Deutsche Bank, on some of the FX moves that we're watching very closely. Now, coming up, more from our interview with the UBS Chief Executive, Sergio Ermotti, as the Swiss lender tops estimates. This is Bloomberg. So let's return to our top story this morning. UBS shares are gaining the most since March last year after the Swiss lender beat earnings estimates and returned to profit after 2 loss-making quarters. Now, the chief executive, Sergio Ermotti, spoke to us about the company's performance and the outlook for the year ahead.
Actually, it's a good momentum. You may remember in the fourth quarter, we also had a very strong performance in banking. As we integrate the new colleagues from Credit Suisse on our platform, we start to see the pipeline developing. We are able to execute. And so it's very much aligned with our expectations of improving the mix between our markets business and our banking business in the investment bank.
So in the investment bank, where do you see the biggest strength? I know we also heard about possible job losses in Asia. Is Asia at the moment weaker than, for example, parts in the US and investment bank?
No, I think that we reinforced our franchises globally. I think that, of course, we are still going through across the entire bank. We are still a lot of work to be done to restructure the businesses and to bring them back into even stronger profitability. So I think that is a good momentum. We achieved almost a 10% return on CET1, which is still a third or 50% away from our final target. So still work to be done. We always say that 2024 is an important year. And as we now approach the end of May, we're going to execute on our legal entity mergers, which allow us to unlock in the future further cost savings.
An important year, 2024, because it's also a more difficult year to 2023?
No, because it's a more, first of all, we have 2 huge milestones, the merger of our legal entities, and the second one, we start to do the migration of clients from the Credit Suisse platforms into the UBS platforms. So this is very technical, still requires a lot of support and people to do that. But as we start to do that, we can unlock some cost savings, but also unlock capital savings, funding savings, and therefore achieving our final targets to achieve 13 billion of savings by the end of 2026. For this year, we do expect half of that being achieved, so 6.5 billion.
Sergio, when you look at global wealth, I mean, the outlook talks about interest rate cuts. Again, how do you worry about things that are outside your control?
Well, things that are outside our control, you always need to wonder what can happen on the geopolitical front, what can happen on any sudden change in the macroeconomic picture. So I think that we do indeed factor in our outlook for NII, for example, 3 rate cuts in the US, 2 rate cuts in Switzerland. This can change. And if it changes, may be beneficiary to our NII, but maybe the underlying macroeconomic event is not so positive. So, we need to always assess. Well, we are prepared for any scenario.
Well, that was the UBS Chief Executive, Sergio Ermotti. Let's bring in our Swiss Bureau Chief, Alessandro Speciale. Alessandro, I mean, look, he was on fine form today. He said, look, everything is in place, but then, of course, the Swiss capital requirements, it's beyond his control. I'm surprised the share price is gaining some like 7 or even 8% as we speak. I'm surprised there's not more worries about that, given how much capital requirements they could need.
Yeah, I mean, investors are really liking the 3 times as estimated profits that UBS reported this quarter. So these were strong results. And clearly investors think that this is a solid foundation going forward, no matter what the Swiss government does. This is a big cloud, this is a big uncertainty, and in Switzerland, if you want, there is a bit of uncertainty. There has been so far a big honeymoon also with the Swiss public. UBS swooped in and saved Switzerland, saved Credit Suisse and, from a big embarrassment also for the whole of Switzerland. Now, of course, there was a bit of noise around Ermotti's pay, most paid banker in Europe. But these results show that UBS is delivering on what it had promised when it took over Credit Suisse.
But Alessandro, I mean, this is a problem. After honeymoon, usually you have your first fight as a couple. I mean, is this a fight? He was trying to minimize actually the impact. And at some point he also said, look, we need more capital requirements to make sure that the system is safe. But again, it's an overhang when you're trying to build profit and revenue to compete with the Americans.
Yeah, I mean, Switzerland went very much in the direction of UBS to make it easier for it to take Credit Suisse. It was very complicated, but now that it's shown that it can deliver, that it is delivering profits, even as it continues this enormously complex integration, I guess there is a sort of big of a backlash from the Swiss side, and also the finance minister, Kelle Sutter, which was the one who orchestrated the takeover, has also said that she was a bit concerned about the level of Ermotti's pay. This is a bit of sort of the swing of the pendulum, but Ermotti has shown that so far it can deliver on what he has promised.
Alessandro, as always, thank you so much for joining us. That was Alessandro Speciale in Zurich. More to come, and this is Bloomberg. Well, Disney is expected to register an increase in subscribers to its streaming service when the company reports earnings later today. Now, for more on all of this, we're joined by Bloomberg's Charlie Wells. Hi, Charlie. So what will investors be looking out for in the numbers from Disney?
Yeah, Francine, so it's all about Disney Plus and parks. So we heard CEO Bob Iger talk a pretty big talk earlier this year about the potential for streaming growth on Disney Plus. This is something that a lot of entertainment companies have really been focused on trying to grow. Now, analysts are expecting some growth there, but perhaps not as big as Iger was talking about during that important battle with an activist investor earlier this year. But also we need to focus on parks. So in 2023, theme parks were actually made up 70% of Disney's operating income. So there's going to be a lot of focus on how many people they can drive to parks, particularly in Orlando.
So, Charlie, Boeing also disclosed, I love Orlando, by the way, Boeing disclosed possible missteps involving the 787 Dreamliner yesterday. That's prompted investigation. What more do we know?
Yeah, Francine, so this is the last thing that Boeing really needs. They have been under scrutiny since January 5th when a door plug blew out on a 737 MAX. Now, this investigation involves a different airline, a 787 Dreamliner. And what we know is that Boeing has alerted authorities that there were potentially missteps in inspections on some of those planes. We know that this is not an immediate flight issue, but it will disrupt production at Boeing factories.
Charlie, thank you so much. Charlie Wells there with the very latest on Disney and Boeing. Well, that's it from Zurich. Bloomberg Brief is up ahead, and this is Bloomberg.